Good morning and welcome to today's webinar brought to you by Antipodes. I'm Matt Dell from Pinnacle Investment Management, the distribution partner for Antipodes. Today's presentation is brought to you by Antipodes Deputy Portfolio Manager, Andrew Bowe. Andrew is responsible for the coverage of the global consumer sector, and prior to joining Antipodes in early 2015, he was an investment analyst at Platinum Asset Management where he spent 10 years. Andrew's presentation today looks at a couple of the key opportunities that we see in a mixed bag of global equities valuations, and that's natural gas and power generation. Now, before I hand over to Andrew, please note that you can ask questions as we go along by clicking on the Questions tab on your screen. And now, Andrew, over to you.
Thanks, Matt. Hello, welcome everyone to Antipodes' presentation and some great opportunities we currently see in the global natural gas and power generation markets. Let's move on to slide 2. For those new to our story, Antipodes Partners is a pragmatic value manager. We're focused not only on cyclical but also potential structural changes that impact global industries and businesses, and nor do we want to limit ourselves to specific regions or sectors, so we are truly global investors. Ultimately, we're aspiring to generate absolute returns in excess of the benchmark over the investment cycle at below market levels of risk. I mean, today the business, Antipodes, we're just over 2.5 years old. We've grown the investment team from 9 to 14 investors, and we've actually recently established a research office in London. On to slide 3, our philosophy. Philosophy is about where managing risk is ultimately what drives returns. We focus on 3 areas of risk management, starting with margin of safety, or it's the price you pay. Before a stock can be considered for the portfolio, it should be able to generate minimum 15% absolute annual returns and greater than 10% compared to its relevant sector. Secondly, we're seeking strong business resilience, which you can enhance with the more ways you have to win. And we've listed a number of the multiple factors or reasons there that need to support your investment case. And you should note also that if the investment case is for a short, the analyst needs to be identifying multiple ways to lose. Finally, manage portfolio risk. We construct the portfolio by monitoring the build-up of correlated known and unknown risk, and we limit the known risk into clusters of no greater than 15%. Because at the end of the day, no matter how convincing your latest or seemingly best idea might be, the market could still prove you wrong. Slide 4 lists what some of those current non-correlated portfolio clusters are on the long side. I mean, for example, there's the emerging market consumer online cluster. Inside that, we include stocks like Tingy, Heng'an, or JD.com in China. And for the Korea better governance cluster, it's got stocks like Samsung Engineering and KB Financial. And at the bottom of the page is a cluster called retail brand incumbents. That includes a number of stocks currently caught up in the market sphere that Amazon is taking over the retail world. It's actually something the Australian retail market is getting introduced to right now. On to slide 5, Antipodes has access to multiple levers with longs, shorts and currencies in which we can be active, which helps enhance our ability to protect the portfolio on the downside for capital preservation, whilst also helping us to generate alpha on the upside. Moving on to market observations and portfolio positioning. On slide 6, titled Spot the Difference. Before we get into discussion around some of our cooking with gas related exposures, it's worth highlighting just some of the market distortions that have helped generate these opportunities. Since the global financial crisis, world markets have been lulled into a lower for longer rates environment, courtesy of those extraordinary efforts undertaken by central banks around the world. We're basically just making a point here that relative to history, real and nominal GDP growth rates for both the US and Europe are actually, they're pretty good. But just a short while ago, you wouldn't have thought so with all of the political noise that was consuming those regions. So we're not saying rates must increase, but the bond yields today certainly look out of sync with where they have been in the past relative to GDP growth rates. From that, we're seeing some excessive levels of distortion in both the debt and equity markets. Low rates in particular have helped drive low price dispersion or volatility in equity markets. On slide 7, we highlight some further points of interest in those equity markets. Here, our quant team has stripped out selected factors or styles that are helping to drive equity markets, particularly in pursuit of long duration. For each factor, it compares the level of valuation dispersion between top and bottom quintiles versus the past 30 years as per the Z score, or if you prefer, the standard deviation. So, growth, or the light blue line, is a standout for reaching a new high to the far top right. It's an indicator of the market that's increasingly crowding into popular growth stocks across sectors and moving further away from the less popular. Then you can see leveraged yield and low volatility factors also, which remain at elevated levels as the market tries to compensate itself with proxies for those historically low interest rates that I just mentioned earlier. Fortunately for us, the valuation multiple dispersion is also near extreme levels, so with the yawning valuation gaps, we're not short of finding stock ideas on both the long and short side. On slide 8, we move to the heat map. This is one of our heat maps that's been refined down to the sector level for industrials, commodities and utilities. Some of those who follow us may be more familiar where we've just taken it to a higher level in the past at a regional and general sector level, but this time we've taken it down into a specific sector. Again, we're looking at it on a 30-year historic trend basis, and we're showing via the colours what is generally expensive and what is generally cheap. In this case, red means valuations are heating up or expensive, whilst blue is cooling down or cheap. And clearly, as you look across it, what looks cheaper than most across the world are the sectors relating to energy and utilities. And on the more expensive front, and generally an area that you'd prefer or would prefer to avoid or potentially look for shorts, are the process industry stocks like refiners and industrial gases. The heat map certainly doesn't provide all the answers, but it does help with guidance among a large universe of stocks that we consider. All right, now let's get on with the global gas story, which begins on slide 9. And for that, we're going to start with the United States. Thanks to the rapid growth of oil and gas shale, total gas production increased at 4% per annum between the years of 2005 and 2014. However, since then, you'll notice it's largely been flat. Partly this has been a function of massive reduction in capital, as well as a shift in operations to the more oily and liquid-rich shales. But also, it is a function of a much higher underlying decline rate. All shale wells exhibit a hyperbolic decline curve, such that a very high initial production rate is followed by a very rapid decline. In some cases, it can be as much as 70% in the first year. Production from shale wells now accounts for 70% of all US gas output and 95% of new production. Consequently, the underlying decline rate is now approaching 25%. And to put all of that more simply, what it means is the entire market must replace a quarter of its production every year just to stand still. And importantly, for our case, after a long wait, this slowdown in production supply is now happening just as demand growth is set to accelerate thanks to a rise in US exports. Indeed, for the first time in its history, the US is now becoming a net exporter of natural gas. That means more gas will escape into Mexico as pipeline capacity expands, and ships have just started to set sail for the first time ever with LNG on board. And the real inflection point for LNG demand is set to happen over the next 3 years, where a large number of projects already under construction are expected to consume an additional 8 BCF per day by 2020. Sticking with LNG for the moment, let's move on to slide 10. Current consensus thinks the wave of new LNG projects coming mostly from the US and Australia will result in a global oversupply of LNG. It's also assumed that given Europe's deep spot market liquidity, well-connected infrastructure and price-sensitive power generation demand, that it will become the dumping ground for this excess LNG, which in turn would put downward pressure on European gas prices and by extension of that, European electricity prices for a number of years. And we disagree for two major reasons to consensus thinking. Firstly, the market is too focused on the supply side of the LNG equation, missing the significant growth in demand from new gas markets such as China. Secondly, we question whether there will actually be sufficient gas production in Australia and the US to meet the future volume commitments of these LNG plants getting built. Whilst talk of gas shortages is now mainstream media in Australia, such an outcome is seen as impossible in North America, even though production growth has stagnated for the past few years. Over the next 3 years, annual global LNG capacity is set to increase by around 100 billion cubic metres per year, and set against current LNG demand of 350 billion cubic metres per year. We do admit this growth in output is considerable. However, put it into the context of total global gas consumption of 3,600 billion cubic metres per year, and it matters less, especially when one considers Chinese demand potential. Over the last decade, you can see Chinese demand has grown 13% per annum, with consumption this year set to come in at around 235 billion cubic metres. That's up 15% year on year. And despite this growth, gas still only accounts for less than 7% of China's energy mix, which is well short of the government's 10% target for 2020 as part of its clean energy policy, given there's so much pollution in China. With domestic Chinese production growth estimates largely dependent on unproven shale reservoirs, LNG is likely to supply the bulk of this additional demand that China's going to need. So far, this is proving to be the case, with Chinese LNG imports surging 50% this year. And when combined with robust demand from new markets such as Pakistan, Jordan, Thailand, even parts of South America, as well as increased gas-fired power generation demand in Europe, we question whether there actually will be an LNG surplus. And with LNG spot prices currently trading at premium to long-term oil-linked contracts, we're feeling somewhat vindicated in our view. But where there is no disagreement is the fact that there is almost no new LNG capacity set to enter the global market after 2020. And given the 4 to 5 year lead time on construction, this sets up the dynamic of a very tight market by the early part of next decade. Now let's feature some stocks where we're investing. On slide 11, we feature a long-held top 10 position in a company called Inpex. Many of you may know about this company already because we have mentioned it in the past. It is effectively Japan's national oil and gas company, best known to some Australians as the operator and 62% owner of the giant 38 billion odd Ichthys LNG project off the northwest coast of Western Australia, and that's now nearing completion. Now, until recently, Inpex had been well out of favour with investors concerned about potential Ichthys, budget cost overrun risk, and also generally the weaker global oil and gas prices that we had been seeing. But with Inpex, we can see multiple ways to win. That includes early next year as the inflection point for the capital expenditure and cash, where CapEx on the project will cease and the production taps will get turned on and start to generate a wall of cash. There's also low political risk. Ichthys is not located in the Middle East or China South Sea, and the owner and customers are reliable Japanese. Also, Ichthys will provide a 40% production increase to the total production of Inpex, which is huge in an industry that has been forced to cut back development and therefore future production over the past few years, given the low energy prices the world has been experiencing. And whilst this is predominantly an energy stock, we can also see value in a cheap, long-duration infrastructure asset. I mean, if you think about it, Inpex via Ichthys is now the gatekeeper to the highly prospective Browse Basin. The capital has already been sunk, and there's a 1 metre diameter pipeline will still have 50% spare capacity, and that pipeline is about 700 to 800 kilometres long. And there is still room to be able to double the LNG processing capacity that's based in Darwin. So with that, either Inpex expands production, or we expect third parties with stranded gas assets can potentially tap into its pipeline and pay a transportation and LNG processing fee. And finally, we think there is ample margin of safety given the low enterprise value to reserve valuation indicated down there on the right-hand side of the chart. And at a $50 oil price, it can produce a 10 to 15% free cash flow yield. Not bad for investors in search of higher yield. Go on to slide 12. We're highlighting some relatively new positions in the portfolio, namely TechnipFMC, Fluor, and JGC, whose core business is engineering and construction of large energy projects. Given the big reduction in oil and gas expenditure in recent years, these companies have all been punished by the market for the large drop in inbound orders. However, we believe that the market is mistaking the cyclical downturn for a permanent structural demise. We actually think we're at the classic bottom of a cycle, with the industry showing signs now of consolidating through mergers and capacity also being rationed. So while we don't necessarily believe in a return to the level of profitability earned in the prior super cycle peak, we are getting compensated by relative valuations that are close or near to 20-year lows. And on the margin of safety, that is enhanced by balance sheets that are all in a net cash position. So each of these three companies is slightly different in terms of their specific offering or skill set, but as the tightness in the LNG market and other energy segments becomes apparent and new projects start to get sanctioned again, we expect these three global engineers to be key beneficiaries. Let's talk some European power generation, and we start that on slide 13. This takes us into the depths of the European power generation market. Another top 10 stock holding is EDF. It's the owner of the largest nuclear fleet in Europe, supplying around 80% of French electricity demand. In the short term, we think it has been unduly punished by European regulators and investors alike, who are not recognising the systematic importance of this asset. Now, the workings of electricity markets in Europe are complex and somewhat poorly understood, largely due to an interplay of national and EU level policies. However, what is abundantly clear is that the German policy of subsidising renewables has had the unintended consequence of knocking cleaner burning natural gas out of the supply stack in favour of cheaper and more pollutive hard coal. This is because power is dispatched according to the short-run marginal cost of fuel. So, as high gas plants were removed from their higher power price setting position and increasingly sat idle, that meant vital peak pricing gradually disappeared. Thanks to EU-led power market integration, this power price melee spread to France and other parts of the continent, depressing French prices to levels EDF regulators never even imagined. Problem with that is that now investors are extrapolating these irrational conditions into perpetuity and not recognising the situation as being simply unsustainable. As the largest cost producer of carbon-free energy in Europe, the EDF system is critical, not only to France, but the entire continent. The all-in cash cost on EDF's power fleet, even in the middle of a very heavy maintenance cycle, is still cheaper than a comparable cost measure for gas or hard coal. And that's even at currently depressed carbon and natural gas prices. Energy demand is also bound to increase with the European economic recovery that's now underway, whilst at the same time baseload capacity is being withdrawn at a record pace. Even electric vehicles or EVs have the potential to further increase power energy demand by, we think, around 0.7 percentage points for every 5% of incremental EV adoption rate. And we think as the marginal fuel shifts from coal to gas, Europe may find itself potentially in a power price supercycle similar to what we've been seeing here in Australia. Poor economics and tighter environmental policies will eventually drive hard coal out of the market, and gas burn will increase substantially, pushing gas and electricity prices higher. Also, we think a way to win is the French government owns 80% of the company, and it has already implemented a number of important regulatory initiatives to bolster the earnings of the French fleet. And after funding this year's $3 billion equity injection and multiple foregone dividends, the government led by Macron is highly incentivised now to make the company work again. It's a high margin of safety, which is derived from the shares trading at a fraction of the replacement cost and the market extrapolating trough earnings for the generation business, which we think makes it one of the relatively cheapest power utility stocks in the world. That completes the feature on natural gas. And just to finish up, we can see on slide 16 some of the key exposures of the whole Antipodes global long-short portfolio. On this, for the month ending September 2017, the total long exposure of nearly 92% is made up of 52% of global-facing stocks and 40% domestic-facing stocks. And bear in mind, of the domestic-facing stocks, nearly half of that's in Europe, when you include the 9% exposure to European financials. Up there at the top line, you can see the energy and industrial services sector combines also to around 9%. And across the whole fund, total net equity exposure of 65% now is towards the upper end of the range that the fund has generally been operating under since inception. For the summary page on slide 15, the key points to remember are, we think investors are overpaying for duration. Price dispersion or volatility is low, but remember multiple dispersion is extreme. And we need to look for asymmetrical risk-reward stock opportunities. And for example, we've just talked about the out-of-favour global gas and energy sector. On the performance front, since inception nearly 2.5 years ago, we've managed to deliver outperformance at below market levels of risk, as indicated there by the average 59% net equity exposure for the global fund. With that, thank you for listening, and I'll pass it back to Matt to finish up.
A member of the Antipodes, the Friendly Pinnacle distribution team is available to provide further assistance to you should you have any requirements. So look, let's take some questions. Andrew, we've got a couple here. There's a question here about cost overruns. So other Australian LNG projects have suffered massive cost overruns in the tens of billions of dollars. What did Inpex do differently?
Yeah, that's a good point, because there were a number of other Australian LNG projects a few years back that they blew out to tens of billions. But point's a valid one. I think ultimately Inpex was probably more lucky than anything else, just because it actually brought on its major project, Ichthys, after, following the others. So that occurred at a time when you could see price deflation or cost deflation happening, and that was happening across the commodities required to build the project. It freed up expensive labour in particular for Australia, so the wage rates were coming down. And also it's freed up that engineering capacity so that you could go back and basically reconfigure the project and sort out better, smarter ways of pulling it all together, rather than discovering some of those errors while you're out in the job. So yeah, there are a number of reasons why, and I mean, it still had its problems. I think it's probably somewhere between $2 to $4 billion over its original budget, but that's certainly a lot less than some of the 10s and 20s that we saw some of the other projects manage to achieve.
Got a couple more questions here. What's your view on the private equity bid for Santos?
I admit personally I'm not particularly close to Santos, but I have seen some of the news articles in the local press. I mean, it's interesting. I mean, one thing to note was it's a US private equity group making the bid, and the head of that private equity group is a woman who actually used to work inside or part of Shell's LNG business. So for me, yeah, I can't say too much on Santos, but I think it's certainly an encouraging sign that some of the insiders are now getting out there and looking to buy up some of these cheap assets that we can see around the world within the energy space.
Andrew, a question here on renewables versus gas. What are your thoughts about that? For example, is it possible that emerging markets will bypass gas as a so-called bridging fuel and go straight to solar?
It's possible. I mean, yes, it's happening today, but the problem is we don't have that base load capacity. So, one of the major issues you're seeing across Germany is that you do need the sun to shine and the wind to blow to support the significant amounts of renewable, capacity they've put in. I think ultimately the solution is going to be when we can find decent, grid-sized battery packs that can harness the power that comes from those renewables in the good times, and then when they're not working because the sun's not shining or the wind's not blowing, they can then leak it back into the grid at those points. But I still think we're a long way from being able to rely on such an asset, hence why it's become quite political, particularly in Australia, around these issues as well.
Question here is a slightly different topic, but what's Antipodes' view on the AUD versus the USD, and also any views you might have on cryptocurrencies, especially Bitcoin?
I'm certainly not an expert on cryptocurrencies, but I'll share a view or an opinion. Just on currency, I mean, we have sort of probably over the last 6 months increased our exposure to the US dollar, particularly relative to the Aussie dollar. I think the Aussie exposure in the fund today is around 6 or 7%. The Aussie, it continues to be in that kind of fair area, between 70 to 80 cents. So yeah, the view really hasn't changed too much on that front. Cryptocurrencies, it's an interesting beast. I think it's also a reflection of the point I was making earlier about lower for longer yields and what's that, the excess amount of money that's generating. And you can see bull markets everywhere, whether it's share markets, property markets, bond markets, and even these cryptocurrency markets. Where it ends, the cryptocurrency, I'm not too sure, but there's certainly valid reasons why they can operate in the economy, particularly the blockchain technology that is supporting those cryptocurrencies can probably become more mainstream in the future rather than the actual cryptocurrencies themselves. But again, I've been proven very wrong so far on Bitcoin. I don't own it myself, but it's been quite fascinating to watch where some of those prices are going.
One final question here, Andrew, just on the current portfolio positioning. What is the current and historical average gross exposure of the fund?
It's been pretty consistent. I mean, the net exposure's been around 55 to 65%, and that's generally been made up of a long position of around 90%, short of around 30%. So I guess that gets you up to a gross of 120 when you combine the two together. So again, we've been pretty consistent with those ranges since inception.
Okay, well, look, thanks, Andrew. That's all the questions we had, and that does conclude today's webinar. Please note that if you would like further information, you should visit the Antipodes website at antipodespartners.com or contact a member of the Pinnacle distribution team. Thank you for dialing in today, and have a good day.